morning, everyone. When I say mortgage rates, what do you think of? Well, like most of us, you think of it as a tool that banks use to get you a mortgage loan. And you're not wrong. But did you know that small differences in interest rates, 3%, 2%, even 1%, can make a big difference in what your client can afford monthly as a homeowner? And that affects us. It's true. Today, we're going to talk about mortgage rate history, which sounds really boring, but understanding how rates impact the buyer is essential to our business. Mortgage rates have seen some major highs and lows since Freddie Mac, a government lender, has been tracking them since 1971. The report is called the Primary Mortgage Market Survey, PMMS. Mortgage rates have topped out at a massive high of 18.63% in October of 1981. That's an incredible 14.13% higher than the national average of a 30-year loan now. And rates dropped as low as 3.13% in November of 2012. And were steady in that range until June of 2013. Then they went up to about 4.3%. Today, they remain on the lower end, averaging about 4.48%, give or take, making it a good time for home buying, which makes it a good time for real estate agents. So to understand how mortgage rates truly affect the home buying process, I have a few examples using the past history of mortgage rates. This is our house.
The calculations you are about to witness do not include taxes and insurance. Numbers are based on principal and interest only. Thank you. Heather rolls.
In 1971, when Freddie Mac started recording, the interest rate was at a low of 7.29%, a high of 7.73%, and it averaged at 7.54%. So if we calculate our $300,000 house at 7.54%, over 30 years, our monthly payment would be $2,106. Again, this is not including the taxes and homeowners insurance, just the principal and interest. And the total cost of the mortgage would be $758,112. In 1981, the low was 14.80%. The high being that infamous 18.63%, and the average was at 16.64%. Now, if we bought our $300,000 house at the highest point in 1981, at that 18.63%, our mortgage payment would be $4,676, and the total cost of the 30-year mortgage would be $1,683,269. In 1991, the market was better, but not great, and our low was 8.35%, our high was at 9.75%, and the average being 9.25%, making our payment $2,468 total cost, being $888,489, a little bit more than it was in 1971. Then let's go to 2001, where the rates were declining. Our low rate was at 6.45%, our high rate was at 7.24%, and our average being 6.97%. Making our mortgage payment $1,990, and our total cost was $716,352. Getting more affordable. Now jumping to 2011, where it really starts getting nice for home buyers. Our low that year was 3.91%, and the high was 5.05%. Average being 4.45%. So if we take our low that year at 3.91%, on our $300,000 house would cost $1,427 a month, and the total cost of the mortgage would be $513,742. That's a whopping $3,249 a month difference from 1981's monthly payment, and a $1,169,527 difference in the total cost of a mortgage. That is insane. To wrap up this presentation, I hope that you now have a better understanding of how the mortgage rates can have a positive or negative consequence on our business, the business of real estate.